and welcome to this week's episode of Macro Mondays. My name is Will Cunliffe, a research analyst here at Flux.
I'm Kokas, research analyst here at Flux as well.
And I'm Harinder Sandhu, a research associate at Flux.
As usual, we'll be taking you through this week's key market data, charts, and risks. We'll be unpacking Trump's tariff threats on China that has been adding to the kind of risk on sentiment. Gold and silver make new all-time highs. Platinum has joined the uptrend as well, so lots going on in the precious metals space as usual. French Prime Minister Le Cornu gets reappointed, and more political turmoil in Japan too. So let's kick off with what's happening with Trump at the moment. So he's re-escalated things in the trade war with China. We've seen he's been threatening a massive increase in tariffs, throwing 100% tariffs around, but there's not actually been any real meaningful threat there. I mean, it sounds like it's a lot of just talk, really. And indeed, he came out over the weekend to kind of calm down the markets, I believe. And that seems to have been the case. What do you guys think going on?
Yeah, of course. I mean, as he highlighted, the tariff deadline is on the 1st of November, which comfortably sits just a few days after the meeting that he's scheduled to have with President Xi. Mm-hmm. But, as he mentioned on his favorite platform nowadays, Truth Social, it's all about mostly the rare earth export controls Chinese put in place. It's basically trying to retaliate and see if China can somehow stop these export controls, because these are adding significant pressure to the US Pentagon.
Of course. I mean, like we saw the US Pentagon come out, they're bidding for about $1 billion worth of rare earths. In terms of, we've seen China build strategic inventories left, right, and center. The US are doing the same now with rare earths, because China really has a strong grip on that market. China have between around 70% total market share of rare earth production globally, and about 90% of processing. So they have that market pretty captive. And not only that, all of Trump's threats, okay, we're gonna put export controls on Boeing. We're going to limit chip exports to China. All of that production depends on rare earths. So without the rare earths, there's no cards in Trump's deck. And I think he's clearly coming to that realization. And it's another taco. We're seeing another taco again. Trump always chickens out. There's a long time until that 1st of November deadline. And if we get there without any meaningful resolution, then I don't know what's going to happen. It's probably just going to be delayed again, as we've seen time and time again.
Definitely, yeah. I think that Will covered that really nicely. The point you mentioned, Spyros, about the 1st of November deadline, I think is especially interesting because, as you mentioned, they're forecast to meet in South Korea on the 31st of October. So it may be, again, a case of like that tit for tat. And as soon as that meeting's over, Trump rescinds these claims for tariffs that he's proposing. I think another interesting point that we were looking at this morning as well is the fees that both sides have imposed on ships now. So China has imposed the equivalent of about a $56 per ton effectively fee for any US ships to dock in Chinese ports. And of course, the US back in April imposed the equivalent of about $18 per ton on Chinese ships. I think also to your point about chip makers, something I read this morning that you reminded me of that I thought was especially interesting is Qualcomm, which is the US, one of the main chip makers in the US. China's recently launched an antitrust investigation, anti-competition investigation into Qualcomm, basically, again, trying to undermine the US chip making in the race of like who can develop the best semiconductors effectively. So, yeah.
Yeah, definitely. And, it's one of those where China have been very strategic in structuring a very well organized supply chain. They have the productive capacity. They're very vertically integrated all the way down the supply chain for chips. And now they're coming out with their own chip technology. So by locking off China, blocking NVIDIA's chip exports, the West has kind of undermined its own comparative advantage, and now China has had no choice but to develop its own proficiency in that space, and it has done so incredibly effectively, and will most likely continue to do that. It's more of the same agenda from the CCP in terms of we want to isolate ourselves from external risks. Let's diversify our trade partners. I mean, we saw that in the trade data today. Trade massively down with the US, but up with Europe and up with Asia. So they're trying to still place their exports. They're still an export-driven economy, but they're diversifying where those exports are going. So minimizing risk that way. And it's all from this kind of strategic mindset to minimize risk exposure, specifically in those kind of concentrated key areas of the economy, like chips and vehicles. And
Yeah, definitely. And to add fuel to the fire, Switzerland is now pushing to reach a free trade agreement with China. They've been quite vocal recently, and I think there's plans to finalize this agreement by the start of next year. So we'll see how this goes, because Switzerland is a massive gold exporter, and now they're diversifying their exports from the US to China. Which we're also going to cover later in terms of gold.
So moving on to the next slide. The S&P took a big hit, didn't it? This kind of really quite big escalation on Friday. Trump was very vocal, as we've discussed. We saw S&P shed 2.7% on Friday. But then again, the broader narrative over the weekend, one of calming. We saw E-mini futures, they were trading up about 1.3%. So we've kind of parred a lot of those losses there. I mean, where do you see this going? Do you think equities will make a full recovery by the end of the week? Where do you think we'll be on Friday on the S&P 500?
Yeah, I think from my perspective, I think probably rebound to close to where we were trading prior to that Trump announcement. From my perspective, it seems to be another tit for tat situation. Trump will likely tackle again, as far as I see it. But yeah, already with the calming talks over the weekend, you can see that the mini futures have traded up, have bounced back quite steadily, and I think they'll probably regain that lost ground very quickly. Equity portfolios will be back in the green.
Yeah, definitely. It looks like this V-shape, this is what's gonna, I think, happen as we open in the US. And as you point out clearly, this seems like another taco trade where you said President Xi had a bad moment. So we'll see how this can go.
And we've seen a bit of an interesting kind of reshuffle of flows recently, because for a long time, no one wanted to touch the treasuries, especially the back-end treasuries. So the clear kind of safe haven asset was gold. But with gold at these levels, we're starting to see people actually taking profit on their gold positions. So people aren't wanting to go to flock to gold for a safe haven asset. They're going back to treasuries, and we've seen treasury yields trade much lower down the curve, all the way down the curve. We've seen the 10-year down at just over 4%, 4.05% now. The 2 years at 3.5. So the whole curve has shifted down. Meanwhile, gold was selling off on Friday, again, probably profit taking. So that lower yield is going to incentivize some flow into equities. I think there's going to be some. It's not going to yield enough, especially with the kind of the fiscal strategy at the Treasury at the moment. I think equities will find some support there.
Yep, and we saw this volatility spiking on Friday. This was the highest recorded option volume activity. Both puts and calls. Trump tends to have this power to whenever he posts on Truth Social to try to shock the market, and he's been successful recently. And as we can see here on the chart, this is that's
opportunistic. Yeah. Interesting. Yeah, I think it seems could be anything, but from my perspective, at least, I would argue that's probably people that are making volatility plays, maybe looking at like out of the money options to maybe gamble on, because with these things we've seen it time and again where the tracker trade reverses pretty quickly and you can make good money on it. So yeah, interesting.
Yeah. But that being said, we had a small correction in gold on Friday, but it didn't last long. We've had gold hit a new all-time high again today, trading up to $4,075 per troy ounce. This is really kind of this has been the barometer, I think, of the dollar debasement trade. It's people have been flocking to gold as value. Before it was dollar treasury. More recently, it's been gold. We saw it break out of that kind of tight range just in the middle of August. Towards the end of August, it broke out, and it's just been steaming up. To me, all the indicators RSI look overbought, but if central banks are still buying, if gold ETFs are still buying, then what's going to stop it?
I think that's a fair point, but we saw a relatively big correction over the week. Gold was trending comfortably below the 4,000 mark. We highlight on the previous morning macro episode that there might be like the 4,000 might be like a stop profit taking strategy, which seemed like it. But then on Friday, when Trump came over, everything changed and again reached a new all-time high. So obviously this uncertainty hedging that's been elevated continues to increase appetite for gold.
Yeah, but of course this week the key story has not been on gold; it's been on silver, and we've had a pretty monumental short squeeze in the LME on silver bullion, and I mean just look at that. That's parabolic. We have breached the previous. It's an all-time high now.
It is
all-time high. There's been considerable tightness in the LME. Inventories have been being depleted for the past 5 years. Supply is being dramatically outstripped by demand globally, and it's running away. We've had a big short squeeze. Everyone's failing to deliver. We've seen the futures curve actually go into backwardation, which for silver is pretty unusual, wouldn't you say, Spiros?
Yeah, as we can see on the next chart, we see the cash to December future spread. It's skyrocketed. This is the highest ever recorded, which is over $3 now.
Yeah.
And as you highlighted, it's all about the liquidity issues. We're running thin. It's about 30 less stocks available in London. And we've been hearing now that New York traders are actually booking cargoes to London to benefit from this physical arbitrage.
When they're flying cargoes in, and we saw this with gold a few months ago. So gold became very tight in London. There's for many reasons, partly because of bottlenecks at the refineries in Switzerland, because of different standards across COMEX, across the LME, different deliverable contractual standards, that is. So that meant that there was considerable tightness. In silver, it's interesting because you don't have the same value per troy ounce. Silver is much less dense than gold. So to capture that kind of arbitrage, you need to be flying over a lot more silver. And that's obviously expensive. And now it seems that spread is wide enough that that's becoming profitable. Speaking to people in the market, I mean, they're saying that arbitrage should start to work its way through, and we should start to see normalization. But it's a slow process. And of course, this sort of level of backwardation, cash versus front month futures, that's just prompt scarcity. That's all that's showing. And I would, I fear for those who are short paper for this month.
Yeah, and you can see that on the lease rates. People are being charged 100% an annualized rate overnight, or let's say if we were to on a yearly basis, if they want to store silver in the LME, it's over 4%. And on normal times, that's just 0.2%.
Yeah, close to zero. Yeah. It's looking concerning. And I mean, it's concerning over in India as well. I mean, India, for example, silver ETFs made up about 40% of the retail segment last year, compared to gold, which was like 5%. So 8 times the amount of leverage retail exposure is to silver. And we've seen the retail funds close their book. So they're not taking any more investment because of how difficult it is to actually take delivery. The trust in the delivery mechanism is not there, and it's breaking down.
Definitely.
So yeah, definitely one to watch. And I mean, the gold silver ratios have blown out.
Yeah, so maybe a bit of historical
they've been
context.
crushed, actually.
They have, exactly. So I think in 1980 and 2011, which are the two previous historical massive spikes in silver, where we breached, we're around that $50 per troy ounce that we were seeing in recent days. The gold to silver ratio, or the silver to gold ratio, I should say, around now is about 1.2%. Back then it was about 6.7%. So from that perspective, you could argue that silver still has it's not so low that it can't potentially go higher. There's still room to the upside from that perspective. The other interesting fact that I was looking into this morning is, in real terms, although we are especially high at $50 per troy ounce, historically speaking, if you were to look at it inflation adjusted, we're actually significantly lower than 1980 and 2011. I mean, there's still, from that perspective, there's some room to the upside. But of course, this is an inventory issue. So looking at the fundamentals, of course, you expect those arbitrage cargoes to come in and solve this problem in the long term.
Yeah, I mean, it's also just a pure problem of supply and demand. In gold, that's pretty exclusively a store of value and an investment vehicle. There's some limited industrial use, but really with silver, there's a massive industrial utility there. It's used across solar panels, across lots of electrical goods. And obviously that demand is only growing and growing and growing, but we haven't seen the same kind of uptick in prospecting or production to match that. So we've been running at deficits for years, and the higher price will hopefully incentivize a little bit more production. We'll see hopefully a bit more prospecting, and that should normalize things in the very long run. But in the meantime, we have serious tightness in the prompt. But anyway, moving on to France. So they've been undergoing some political turmoil, haven't they? What have you been seeing there, Spiros?
Yeah, I mean, it's pretty much the same story. Macron tries to form a government, and he has no power right now. He reappointed Lecornu. Lecornu stepped down last Monday, and on Friday he said he's going to be reappointed. And it's quite interesting that same finance minister, same budget minister has remained in the cabinet. They've also formed a cabinet. They actually did yesterday, and they're expected to have the first meeting on tomorrow, actually, to decide about the budget, to propose the budget for the fiscal year of 2026. But it seems.
What does this mean for markets? I mean, I think everyone's looking at the fiscal stance in France pretty hawkishly.
Yeah, I mean, the market was kind of there wasn't as big as a reaction as last week, but investors are worried, basically because that was Macron's last chance. If the cabinet is not being approved or the budget is not being approved, the other option he has is to have a new election. And we see far right and far left are increasingly getting more majority in the parliament. And it's for Macron. I think most of the concern is the far right right now. They're being increasingly getting more, let's say, dominance and popularity in France. And there's something that Macron has to consider, either far right or to step down.
Yeah. So where do you see it ending up? What if you were a betting man? What's going to happen in France?
I mean, it's clear, as we can see here, at least for euro dollar. I expect euro dollar to go a bit lower. There seems to be support. I wouldn't be surprised if we go even below 115 in the short term, just because France is the second biggest economy. And, everything that's happening right now, it's very harmful for the euro area.
Yeah, I think that there's a few factors at play here. I mean, one is obviously the euro dollar had strengthened a lot. We were at pretty high levels for the euro against the dollar. Part of that was obviously the dollar sell-off, but part of that was also not much from the ECB being priced in. And I think as markets come to realize that the eurozone is struggling to post much growth, and the more accommodative stance from the ECB will be necessary, I think we have some downside movement possible there. I also think it's, as a net exporter, the ECB will be careful not to let the euro dollar appreciate too much. They want to stay competitive, and part of that requires having a competitive currency. So I see downside as well in the euro dollar.
Yeah, and the euro area has some inflation concerns right now. There seems to be, countries like France and Germany seem to be slightly lagging behind. Some recent inflation prints were pretty low, let's say. Some economies struggle to maintain that 2%. So we'll see. You have, as you mentioned, clearly China is exporting a lot to Europe.
Yeah.
And that's gonna be
deflation.
Yeah,
it's exported deflation.
Yeah, exactly. They export with really cheap prices, and we'll see how this can go.
Yeah, definitely. But I mean, it's not just France in political turmoil at the moment. Japan is having its own issues too. The 26-year ruling coalition has collapsed after talks between the new LDP leader Sanae Takaichi and Komito's. Sorry, I'll let you pronounce those names.
Not too outside.
As talks between both leading members have broken down. It's again about political funding. It's about debt. It's about in Japan they have a lot of it. You can say that. I don't see any sort of reversal coming here in terms of fiscal strategy from Japan. They're going to have to guard the yen pretty well. If we've seen the yen kind of trade lower, soften against the dollar pretty consistently as it approaches that sort of 160 mark. I think the BOJ will most likely start to hint that they might do something. We've had them kind of in the past, as we've been getting towards the 160 mark, they'll kind of leak rumors to traders saying, yeah, we're thinking of buying. And that itself, that sentiment improves and it pushes it up. If we see an actual test of 160, then they could come out and start doing some intervention. What's your take on Japan?
I'm really worried, especially on the G7 economies right now. You have UK, the government is falling to pieces. They cannot even form any decisions right now. Then you have France, they cannot even have a cabinet. They're struggling to appoint prime ministers. And now you have Japan. Obviously, there's a bit more clarity in Japan, but we see them being a little bit more fiscally irresponsible, let's say. All these cut taxes and everything has to be funded somehow. And, having a 250% debt to GDP ratio is not going to be very helpful for foreign investors.
No, for sure. But then again, what you do have is a very trigger-happy Bank of Japan that'll just inject liquidity when they need to. And I don't think that's going to change.
Yeah, no, I totally agree.
But then back over to commodities. So it's been an interesting week in the oil markets. We saw a pretty aggressive sell-off in Brent towards the end of Friday's session. We traded down to almost a $62 handle. That's the lowest in quite a long time. It's down from, we were touching 70 at the start of the month. So there's a multitude of different drivers here. For one, you have a huge amount of kinetic escalation between Russia and Ukraine, but that's hitting the processing capacity in Russia. So that's hitting refineries. That's not necessarily hitting, the pumps. That's not hitting the Urals pumps. We're not seeing less ESPO being produced. We're seeing less refining, and that means that there is a clear demand outlet for Russian crude, right? So that's gonna weigh on oil prices. But we've also obviously had a broader kind of risk-off sentiment. We saw equities trade down, and often oil trades as a risk asset. Yep. So, there's going to be a little bit of contagion there. We're going to see people take profit potentially on their gold positions and look to take profit on their oil positions as well. But the bounce back, as we discussed earlier, that's more of the same kind of trade deal neutralization.
Yeah, it was particularly important what happened on Friday. As you pointed out, Russia has been refining rates are running a bit lower, and we've seen recently they're exporting on higher volumes than they used to.
Yeah.
But also the Friday's questions were around Chinese demand. So the Chinese, the Saudi allocations to China, which they tend to be on a monthly basis were significantly lower. We expected them to be lower because the official selling prices of the Saudis remained particularly strong. But this 39 million barrel over the month of November raised some questions, and we saw the big steep drop happening throughout the day.
I mean, you say it's an interesting point on the allocations. I mean, you do see a kind of seasonal downturn for the allocations for November, which is the batch we just received. On the OSP side, it's true that they held them flat for the benchmark kind of Arab light into Asia. They held them flat. Structures had actually implied a kind of 40 cents hike. So we had them actually issuing the OSP at a bit of a discount. And that follows again from the month prior, which was for October barrels, where they cut by $1 instead of the 50 cents implied. So again, we're seeing them kind of they're keen to maintain that customer in the East. They got a little bit scared was it 2 months ago that allocations were a little bit lower than we were expecting?
Yeah, and then we bounced back to
and then we bounced back.
This year's high of 51 million barrels.
Exactly. After that, more lenient OSP. Well, they gave a lenient OSP, and it wasn't necessarily met with a big uptick in allocations. So, I mean, what do you think? For a long time, this huge surplus, this super glut, people are calling it, has been kind of supported by Chinese SPR buying. It's been strategic purchases for energy security. And that's been kind of eating away at that kind of 1.5 million barrel surplus. Without that there, what's there left to keep the oil market propped up?
Yeah, that's the main question. I mean, everybody has been asking whether China would come from the bank holiday they had and continue buying.
Yeah.
People were worried on Friday when the allocations came, but the prompt structure has remained significantly strong. We're about, we had this big drop in Brent, but we saw the prompt spread, the December to January future spread. It was holding significantly strong, like 40, 45 cents.
Yeah, last week it was, yeah. I mean, it's softened a little bit since, but nevertheless, it's still backwardated. The market is not screaming super glut, and I think that's been confusing a lot of market participants. You have people like Macquarie, the IEA, coming out saying we're going to build inventories at 4.1 million barrels per day to 4.6 million barrels per day in the first quarter of next year. Yet the time spread structure is saying no, crude is still scarce. It's still a scarce commodity. We have prompt demand. It's the same as silver. The backwardation is indicative of prompt scarcity. So it's a little bit perplexing. And yeah, I think perhaps the builds aren't quite so big. Perhaps we are still getting a lot of strategic purchases from China. And perhaps demand is just better than people think. In the 2008 global financial crash, we saw maybe 2 million barrels per day off total demand. So total global crude, total oil demand, total liquids demand fell about 2 million barrels per day in the 2008 global financial crisis. Now, if we had a similar recession like that, I can understand perhaps, okay, given OPEC's unwinding, given we've got a huge level of demand destruction, maybe there's 4.6 million barrel builds, but I can't foresee that in the foreseeable, especially given the time spread structure where we are today.
Definitely.
But moving on, we had some Chinese data, so we've had a bit of a lack of US data with the shutdowns, so it's been a quiet week from the US, but we had some export and trade data from China. So what have we seen going on there, Spyridon?
I mean, as we touch base on crude, let's start with crude. Crude imports were around 11.5 million barrels per day. Obviously, this is slightly lower than August, but for the month of September, this was higher than last year.
Okay.
So there was still some demand, but let's touch base on others. We saw exports rising 8.3% year on year. US is obviously down almost over than a quarter. but it's up on the EU, it's up on other Southeast Asian countries. So China is trying to reach other destinations, diversify their exports. What do you think about it?
Yeah, I mean, there's a few different factors to play again. I think the first thing that I wanted to actually mention earlier was the strategic buying by China. We're always trying to estimate like Chinese inventories, right? We're trying to estimate what their capacity is for crude, especially. But it's like it's very difficult to gauge what that level will be at. So whether or not there's room for further purchases and building inventories is remains to be seen. The tariff situation.
They have room.
Yeah.
Like, I think, with estimates are somewhere around the 1.3 billion barrel mark. And they have, at least 1.6. And that's only what we can see from the satellites. We don't know the extent of underground storage, for example.
Right.
So they definitely have room. But it's just a question of whether they will perceive that they have need. I think it's a question of need, not space.
Right.
Yeah.
And I guess if we were to see continuing falling in prices with the tariff situation escalating, similar to how we saw it previously in the year, where markets were considering real possibility of a global recession should these tariffs persist. That might be the case for China to come out and start buying again. Elevate the Chinese buying and keep flat price supported. Yeah, exactly.
Yeah. I mean, they're flat price buyers. They like to buy below 70. Anything below 70 is fair game for the Chinese.
Right.
But we were seeing that they were building at like 1.2 million barrels per day earlier in the year. I mean, that's a lot. Will that be sustained? I mean, we've heard reports that they're going to look to build at 500, 700,000 barrels per day. I think no one knows. I think it's impossible to tell. They will probably make the assessment then and there. Mandate one of the big Chinese oil companies to go out and purchase some crude and to stick in storage. But
there's only one thing
it's a
we
force
know,
to be reckoned with.
at least from the data we're being given. Rare earths exports to the US are down.
Yeah.
This significant follows the argument we had with the tariff threats from Trump's side.
Yeah.
And you highlighted perfectly earlier about the US Pentagon, which they really need rare earths, and they were 31% month to month down.
Yeah.
And this is half of what June's record.
Yeah.
So where do we see this going?
Well, I mean, it's clearly a strong card that the Chinese hold. Everything from defense to solar panels to EVs, anything with electronics will most likely need rare earths. And Trump is aware of this. It's part of the reason why the reciprocal tariffs that were enforced on India of 50% weren't mirrored for China. They were both buying Russian crude. Only India got slapped with the additional tariffs. China got a bit of reprieve there because they stopped shipments of rare earths. And they're happy to do that. They will say, no one's having it. Not just the US isn't having it. No one globally is having rare earths. And that's a very powerful position to be able to exploit. And Trump has no answer. I mean, what do you guys think? What can Trump do, do you reckon?
I mean, yeah, like you said, it's a necessity, and that's the reason that he's been partially, at least, looser on China compared to India, is that they have a requirement for those commodities. I think, I mean, earlier in the year, he made a very, very strong case that tariffs are necessary to protect the U.S. economy, and that's a step that he needs to take, and it's temporary pain, and it's like a medical procedure for somebody, short-term pain for long-term improvement. But really, even economists have debated as to whether these tariffs even generate the income that can, or create through the revenues. And Trump's argued that those revenues that they generate will circulate back into the U.S. economy, but really just being tariffed. The tariffs just get incorporated into the prices, and it's more prices for the consumer to pay at the end of the day, right? Yeah. So whether or not the tariffs get implemented, prolonged for a long period of time, does still remain to be seen. But without a doubt, it's a very delicate game he has to play with China now, with with the dominance that they have across these sectors. So yeah.
And then back to metals. I mean, it was obviously a pretty wild week in silver, but platinum is also testing its 10-year high, up more than 3.6% this morning to 1,656 per ounce. I mean, where do you see that going? I mean, that also looks pretty parabolic to me.
Yeah. We had been very bullish last week on the previous episode on platinum. I had been testing new highs, and there seems to be some upward momentum going on. I wouldn't be surprised if we exceed these 10-year highs over the next one or 2 weeks.
Yeah,
It seems like precious metals are following what's happening right now. All this kind of concern. Silver, gold, and platinum is the next one that's following.
I mean, it's all relative value as well. You know, if you have gold rallying hard, if you have silver rallying hard, palladium rallying hard, then it makes sense that the other precious metals are all going to get dragged up with them. And I think that's what we're seeing. So, I mean, we saw palladium break out as well. Platinum's testing highs now. It seems like a pretty bullish thesis from my perspective.
Yeah, definitely.
And the US has also been testing the waters with a treasury swap line, not a Fed swap line. We've seen them intervene in the Argentinian peso.
Yeah, this is massive. This isn't something you tend to have in the financial markets, a country intervening in another country to stabilize the currency. 20 billion of a currency swap that we saw on Thursday being announced by Besant.
Yeah.
This is huge news. They try to be very supportive of the current government, and they want to give some extra boost to keep the government in place. But the question is, we had these discussions about Argentina being big, but how is Argentina gonna fund this in the near term?
It's an interesting strategy, I think, because the central bank is not foreign to extending swap lines. So the Federal Reserve is a participant of quite a vast dollar swap line network, which it has utilized during periods of offshore dollar liquidity tightness. So you might see dollar liquidity dry up in Switzerland, for example, and then they'll be able to extend the swap line to Switzerland and then reverse that later. In some ways, they're kind of acting as the global lender of last resort. It enables them to provide liquidity when there needs to be liquidity overseas. What's less common is a treasury swap line, and I mean, this seems politically fueled, right? Would you agree?
Yeah, definitely. I mean, Milei has lost some elections in Buenos Aires, and we have the big elections coming up next month. So definitely trying to help the current government maintain its position.
Definitely, but I mean, the peso is still struggling.
Yeah, it has been struggling, although it gained slightly on the day. When it was trading down, it was almost 1% higher on the day on Friday, but it has been struggling.
Considering it's a $20 billion swap line, I don't know, I think I would have been expecting a bit more of an uptick.
Yeah, I think investors are concerned. There's nothing really clear right now going forward, so I wouldn't be touching the peso personally.
Yeah, and I mean, we also, moving on to crypto, we saw a pretty aggressive move down in Bitcoin. We had a record $20,000 candle on Friday. I mean, that's huge.
Yeah, it is massive. The cryptos tend to be volatile, but this is the largest ever recorded daily drop.
Yeah. Typically the liquidity, I mean, the volatility in Bitcoin is about 7% daily, which is obviously higher than any of your typical asset classes, but a $20,000 drop for it to recover slightly it's just incredible. And it just goes to show that when people sometimes make the argument that cryptocurrencies should be somewhat decorrelated and because they're decentralized and they're not like a fiat currency, but really this just goes to show that it's affected just like other asset classes when Trump goes and tweets and makes these statements.
I mean, why do you think that happened? Risk off? Is it what's driving that?
Yeah, I mean, there's a couple of points that we could go into. Maybe the argument is that, well, Bitcoin's obviously quite tied to the dollar, and it could be the case that people in the crypto market saw that statement as a sign of a weakness in strength in the dollar and weakness in Bitcoin potentially. It's like from that perspective. it could be a number of things. Also, just generally, like because they tend to correlate with risk assets, you'd see prices in Bitcoin fall off. Wider context, the US has discussed potential Bitcoin reserve, and perhaps this could be a reflection of the fact that won't really be going ahead. But again, for such a short-term move, it's really just a response to a headline, as far as I see it.
I mean, we tend to see now cryptocurrencies tend to somewhat correlate with other asset classes. Equities were down. We said the largest drop since April. Bond yields were down. Dollar was down. I'm not surprised Bitcoin was down, but this was enormous.
Yeah, huge. Okay, so moving on to central bank pricing of cuts for the next 12 months. The Fed, we've got 108 basis points. I think the next two meetings, we have cuts basically fully priced. Be interesting to see what transpires there. I mean, we've had very limited data out of the US, so it's kind of hard to form a picture. And I'm sure the Fed are in a similar boat. But in the ECB, we only have 14 basis points of cuts. Bank of England has 39 bips. The RBNZ, 37 basis points. Bank of Australia, 36 basis points. Canada is 26 bips of cuts, and the Bank of Japan, we have 41 bips of hikes. I mean, to me, again, it has to be the ECB standing out there. I think they're going to have to move a little bit more over the next 12 months to the downside. Perhaps 100 bips over the next 12 months is a little bit optimistic at the Fed. I mean, what do you guys think?
I think with two cuts right now, if they, it seems like we'll see what Fed Chair Powell is gonna say tomorrow. But as you specified, there's no data right now, so they don't want to shock the market. We saw that recently. So if the market is pricing but over 90 or 95% chance of a rate cut, they don't want to disappoint the market.
Well, I don't know.
They did last August.
I'd say, don't fight the Fed. I think there might be, if they're lacking information and they have to take a view over this next 6 months, you have a labour market, which is, it's cooling, but it's not quite flashing yet. We've got unemployment at 4.5%, less than. That's not overly concerning. The trajectory is not great, but it's not concerning. Inflation's remaining stubbornly high. 2.9% was the most recent print, and I think that's going to be the sore point. And I think they're going to be looking at that at the next meeting.
Let's see if they're concerned with the government shutdown, because we mentioned that basically a week of having the government closed would result in 0.1% drop on GDP per week. So this is the second week we're running right now. So let's see if there is any concerns on the side.
So onto the data this week. We have on Monday, we have India's inflation coming out today. On Tuesday, we'll have a few central bankers speaking. We've got Powell himself, Waller, and Collins speaking. I mean, it'd be interesting particularly to see Waller's speech. He's been pretty dovish in quite a clear attempt to appease Trump, clearly vying himself up for the next spot at the top. We've got UK unemployment, German inflation, and Europe area economic sentiment.
And then on Wednesday we have Chinese inflation. Will be particularly interesting. Been consistently on running below target, so that would be something we'll monitor that. Then Japan's and Euro area's industrial production, French, Spanish inflation numbers, Indian employment and trade, trade balances, and a couple of other Fed committee members speaking on Wednesday. And then on Thursday we have UK GDP. We'll see how this can go. Japanese machinery orders and Philadelphia Fed data.
And then on Friday, we have the Euro area inflation and the US industrial and manufacturing production statistics. I think, a number of headlines coming out here that will be quite interesting to watch out for in terms of what the ECB might be pricing for the coming 12 months in terms of cuts. We've got a number of Euro area inflation data and some economic sentiment. So that will be quite interesting too.
Anything of particular interest? other than that?
Well, GDP for us is going to be.
Well, I think more broadly, I think it's going to be following Trump's Truth Social, staying attentive to any developments on that side. Also, from an oil perspective, keeping tabs on what's going on between Russia and Ukraine. There's been a few very high-profile kinetic escalations against oil infrastructure. So see how that progresses. That's going to be pretty pivotal in the trajectory of flat price this week, I think.
Yep. Yeah.
Cool.
So that'll be all from us this week. Thank you very much for watching. We'll see you next week.